For nearly half a century, the United States maintained global dominance by ensuring that the world's most essential commodity, oil, was overwhelmingly traded in US dollars, creating a system that reshaped the global economy. This dollar-based system allowed Washington to borrow cheaply, finance large deficits, and project power through economic and military channels that no rival could match. The foundations of this system were established when Saudi Arabia agreed to price its oil exclusively in dollars, guaranteeing continuous global demand for American currency. This arrangement was known as the petrodollar system, and it became one of the most influential financial architectures of the modern era. Today, however, seismic changes across global energy markets are calling the durability of that system into question. China has emerged as the world's largest energy importer, and its influence over the Middle East has grown steadily through long-term investments and strategic partnerships. Beijing's objective is clear, as it seeks to increase the use of the yuan in global energy trade to reduce dependence on the dollar. Reports indicate that Saudi Arabia is seriously evaluating the possibility of accepting yuan for at least part of its oil exports to China. This development has triggered major geopolitical debate, because even a partial shift away from the dollar would weaken the foundation of the petrodollar system. Analysts note that China's Belt and Road Initiative provides the infrastructure that supports long-term trade settlements in alternative currencies. Russia, following extensive sanctions related to the conflict in Ukraine, moved aggressively to price its energy exports in rubles, yuan, and various regional currencies. This shift allowed Russia to bypass Western financial systems, accelerating the creation of parallel payment networks. The cooperation between China and Russia has deepened significantly, forming an energy alliance that operates independently of US financial influence. A growing number of countries in the Middle East and Asia are diversifying their currency exposure to reduce vulnerability to American monetary policy. The United Arab Emirates has expanded trade agreements that include yuan-based settlements for energy and non-energy goods. India has also begun exploring bilateral trade arrangements conducted in rupees to strengthen local currency usage. The expansion of BRICS marks another major shift, with Saudi Arabia, Iran, the Way, Egypt, and Ethiopia now joining or aligning with the coalition. BRICS nations collectively hold enormous influence over global energy production and consumption. Combined, they control vast reserves of oil, natural gas, critical minerals, and strategic industrial capacity. If BRICS nations collectively decide to diversify energy transactions away from the dollar, the global financial system could experience unprecedented structural changes. China has invested heavily in creating financial infrastructure capable of supporting alternative currency settlements. The Shanghai Petroleum and Natural Gas Exchange already facilitates yuan-denominated trading at a scale previously unimaginable. China's long-term strategy emphasizes reducing reliance on the dollar for cross-border trade. Russia and China have expanded their cooperation on pipeline infrastructure, enabling energy flows that bypass traditional maritime routes controlled by Western-aligned institutions. Middle Eastern nations are reassessing their geopolitical dependencies due to evolving global security dynamics. Saudi Arabia has increased diplomatic engagement with China, signaling a shift toward a more multipolar approach. This transition reflects a broad global trend toward diversification of economic and political alliances. Oil exporters are increasingly seeking to reduce exposure to a single currency for risk management purposes. The United States faces rising pressure due to high national debt, persistent inflation, and declining foreign demand for treasury bonds. Foreign central banks have reduced their purchases of US government debt, raising concerns about long-term sustainability. Higher interest rates in the United States make borrowing more expensive, increasing the cost of servicing trillions in federal debt. If global demand for dollars decreases, US financial markets could face significant instability. The Federal Reserve plays a central role in shaping global liquidity conditions, but its policies affect emerging markets in unpredictable ways. Many emerging economies have experienced capital outflows whenever the Federal Reserve tightens monetary policy. Shifts in global liquidity impact exchange rates, inflation dynamics, and sovereign debt sustainability. This vulnerability encourages nations to explore more stable and predictable bilateral currency arrangements. Digital currencies are emerging as a new frontier in global finance. China's digital yuan is already in widespread pilot usage, enabling cross-border transactions without reliance on traditional banking networks. Several nations are accelerating development of central bank digital currencies to modernize their financial systems. Digital currencies offer faster settlement times, improved transparency, and reduced reliance on intermediary institutions. As digital financial systems expand, the dollar's grip on global payments could gradually weaken. The energy sector remains the most powerful lever for influencing global currency usage. Control over energy trade routes is increasingly seen as a strategic asset. China has secured key maritime and overland transport corridors through long-term investments. Russia maintains vast energy reserves that give it leverage in geopolitical negotiations. Saudi Arabia retains unmatched influence over global oil supply adjustments through OPEC. These three powers collectively hold the ability to reshape global energy pricing systems. Energy markets are becoming more fragmented due to competing geopolitical interests. The United States still remains a dominant energy producer through its shale oil and natural gas industries. However, American energy exports primarily serve European markets, not Asia. This geographic distance limits the United States' ability to influence Asian energy pricing dynamics. China's increased influence in the Middle East enables it to shape regional energy frameworks more effectively. Saudi Arabia's Vision 2030 program aims to diversify the kingdom's economy and reduce dependence on Western markets. This diversification increases the likelihood of currency experimentation in global trade. Geopolitical competition over energy has intensified due to rising global demand. Nations with large energy reserves have gained increased leverage in international negotiations. A shift toward multipolar energy alliances is becoming more visible. Global oil markets are transitioning from Western dominance toward a diversified power structure. Many analysts predict that the next decade will produce substantial changes in global currency hierarchies. Even modest increases in yuan-denominated oil transactions can influence the balance of global currency reserves. Central banks around the world continue increasing their gold holdings to strengthen financial resilience. Gold accumulation reflects concerns surrounding long-term monetary stability. This increase in gold reserves suggests declining trust in traditional fiat-based systems. China and Russia are among the largest purchasers of gold in the modern era. Gold-backed financial instruments are gaining traction in certain regions. Some analysts speculate that future BRICS financial instruments could incorporate partial gold support. Supply chain disruptions have accelerated interest in localization strategies. Nations are strengthening domestic energy and industrial capacity to reduce external dependencies. Resilient supply chains require diversified financial channels. These structural adjustments impact the demand for global reserve currencies. The dollar remains the world's most liquid currency. International investors continue to view US assets as comparatively stable. However, long-term confidence depends heavily on the sustainability of American fiscal policies. Rising geopolitical tensions increase the desire for financial diversification. The conflict in Ukraine intensified global economic bifurcation. Sanctions demonstrated the geopolitical risk of over-reliance on the dollar-based financial system. Nations observing these developments are reconsidering their exposure to US-controlled networks. China continues expanding its digital payment networks for international use. Cross-border payment systems outside SWIFT are gaining momentum. Financial multipolarity is becoming a realistic long-term scenario. Some energy exporters now prefer bilateral agreements over global frameworks. These agreements reduce currency volatility risks. Oil importing nations seek more flexible settlement arrangements. Global energy consumption patterns are shifting toward Asia. Asia's rise increases the influence of regional currencies. Nations dependent on energy imports want greater control over currency exposure. The United States remains a global financial leader but faces emerging competition. The long-term dollar outlook depends on maintaining global trust in American institutions. Many countries are developing contingency plans for currency diversification. The transformation of global energy markets is accelerating these plans. Analysts expect multiple reserve currencies to coexist in the future. The yuan's influence will likely grow as China expands economic partnerships. The petrodollar system will evolve, but not disappear suddenly. The global financial order is entering a gradual but irreversible transition. The next decade will determine how power is distributed among major economies. Energy alliances will shape financial influence more than ever before. Nations with strategic resources will guide global currency trends. The dollar will remain essential, but will increasingly share space with rising alternatives. The world is moving toward a more complex and interconnected financial network. The silent transformation unfolding today may redefine global power for the rest of the century.